T here. What you're about to see is the clearest evidence yet that the paper silver market is operating in a completely different reality than the physical market, and the divergence just hit a level I haven't seen since March 2020. In the last 72 hours, silver dropped 8.2%, from $28.14 to $26.71. Panic selling, right? Wrong. In that exact same window, COMEX registered inventories fell by 47 million ounces, and physical premiums spiked to 19% over spot at major dealers. The paper market is selling what the physical market can't deliver, and if you don't understand what that means, the next 90 days are going to be very educational or very expensive. Let's get to the data. First, the price action. Silver peaked at $28.14 on February 3rd. By market close February 6th, we're at 26.71. That's an 8.2% drop in 3 sessions. Volume was elevated, 47% above the 30-day moving average. This was algorithmic, coordinated selling, not retail panic. Now here's where it gets interesting. COMEX registered silver, the physical metal available for immediate delivery, stood at 85.3 million ounces on February 3rd. As of this morning's data, February 7th, we're at 38.2 million ounces. That's a drawdown of 47.1 million ounces in 4 days. For context, the average weekly withdrawal rate over the past year has been 2.8 million ounces. We just did 17 weeks of average withdrawals in 4 days. And premiums? American Silver Eagles are trading at $6.83 over spot at APMEX as of this recording. That's a 25.6% premium. Generic rounds are 5.12 over spot, a 19.2% premium. Junk silver bags are going for $23.40 per face value dollar when spot equivalent is $19.56. That's a 19.6% premium. So let me be clear, paper silver is down 8.2%. Physical silver premiums are up 340 basis points in the same window. If you think that makes sense, you don't understand the market you're in. Now let's connect the dots, because silver doesn't move in a vacuum. The DXY, the dollar index, spiked from 103.2 to 106.8 in this same period. That's a 3.5% move in the dollar, and it's the primary driver of the paper silver sell-off. When the dollar strengthens, dollar-denominated commodities get algorithmically sold. This is Econ 101. But here's the problem. That 3.5% move in the dollar doesn't explain an 8.2% move in silver unless there's leverage involved. And there is. Silver lease rates, the cost to borrow physical silver for short-term delivery, hit 8.3% annualized on February 5th. For context, the average lease rate over the past decade has been 0.4%. We're at 20 times the historical average. That tells you there's a shortage of physical metal available to borrow, which means short sellers are paying a massive premium to maintain their positions. Bitcoin dropped from $103,200 to $94,800 in this same window. That's an $8,400 drop, or 8.1%, nearly identical to silver's 8.2% drop. Why does that matter? Because it tells you this is a risk-off, liquidity-driven event. When Bitcoin and silver move in tandem, it's not about fundamentals of either asset. It's about cross-market deleveraging and margin calls. And then there's the 10-year Treasury yield. It went from 4.38% on February 3rd to 4.51% as of this morning. That's 13 basis points in 4 days. When yields spike like that, it signals two things. Either inflation expectations are rising, or the bond market is demanding higher compensation for risk. Either way, it's deflationary for risk assets in the short term because it pulls liquidity out of speculative positions. So what we have is a coordinated macro liquidation event. The dollar rallied, yields spiked, Bitcoin sold off, and silver got hit. But here's the key. The physical silver market didn't participate. It went the other way. That divergence is the story. All right, here's your fork in the road. 2 scenarios. Both have precise technical and fundamental markers. Let's walk through them. Scenario 1, the bull case. Physical market wins. If the physical market asserts itself over the paper market, here's what happens. Silver reclaims $27.50 within the next 7-10 trading days. That's the breakdown level from February 4th. If we get back above 27.50 and hold it for 3 consecutive sessions, the next resistance is $28.90, which was the September 2024 high. Break that, and we're targeting 31.50 by mid-March. Why 31.50? Because that's the 61.8% Fibonacci retracement of the 2011 high to the 2020 low. It's also the level where open interest in COMEX futures historically gets concentrated. The bullion banks have a massive short position clustered between $30 and $30. If we break through that zone, you're looking at a short squeeze that could take silver to $35 by April. The fundamental catalyst for this scenario is COMEX inventory depletion. If registered silver falls below 30 million ounces, and we're already at 38.2 million, the exchange will face a credibility crisis. They'll either have to halt delivery, which destroys confidence, or they'll have to raise prices to attract physical supply, which triggers the squeeze. Supporting indicators: lease rates staying above 6%, premiums staying above 15%, and the dollar rolling over from the 106 to 107 resistance zone. If DXY drops back to 104, silver catches a bid. Scenario 2, the bear case, paper market wins, for now. If the dollar continues to strengthen and yields keep climbing, silver could break support at $26.40. That's the 200-day moving average. Break that, and the next support is $24.80, which is the June 2024 low. If we hit $24.80, you're looking at an 11.8% drop from current levels. The fundamental case for this scenario is deflationary deleveraging. If credit markets tighten, margin calls accelerate, and forced selling hits all risk assets. In this environment, silver gets sold not because anyone wants to sell it, but because it's one of the few liquid assets that can be dumped to meet margin requirements. The key tell for this scenario is open interest in COMEX futures. If open interest drops below 180,000 contracts, we're currently at 197,000. That's a sign that speculative longs are capitulating. When longs exit en masse, there's no bid to catch the falling knife. Supporting indicators: DXY breaking above 107.5, 10-year yields hitting 4.65%, and Bitcoin breaking below $92,000. If all three happen, silver tests $24.80. But here's the critical point in the bear case. Even if paper silver hits $24.80, physical premiums will likely spike to 25 to 30% over spot. Why? Because physical buyers know that paper price disconnects are buying opportunities. Every time silver has crashed in the paper market over the past 3 years, physical demand has surged within 72 hours. So even in the bear case, the physical market is setting up for the next leg higher. It's just a question of time frame. So what do you watch in the next 24 to 72 hours? Number 1, the $26.40 level. That's your line in the sand. If silver closes below $26.40 on a daily basis, the bear case is in play. If it holds above $26.40 and starts to reclaim $27, the bull case is alive. Number 2, COMEX registered inventories. Check the daily reports at the CME Group website. If registered silver drops below 35 million ounces, that's a red alert. The exchange is running out of deliverable metal. If inventories stabilize or increase, the pressure is off, for now. Number 3, lease rates. Go to Kitco or check Bloomberg terminal data. If lease rates stay above 6%, it means physical tightness is real. If they drop back below 3%, the shortage narrative is overblown. Number 4, physical premiums. Track APMEX, SD Bullion, JM Bullion. If premiums expand beyond 20% over spot, that's confirmation that the physical market is diverging further from paper. If premiums compress back to 10-12%, it means supply is catching up to demand. Number 5, the dollar index. Watch the 106-107 zone. If DXY breaks above 107.5, risk assets, including silver, will get sold. If DXY rolls over and drops back toward 104, that's your green light for silver to bounce. Now zoom out. What's really happening here? The monetary system is broken. Central banks are trapped between inflation and insolvency. They can't raise rates high enough to kill inflation without blowing up the debt markets. They can't lower rates without reigniting inflation. So they're stuck in this no man's land where they pretend everything is fine, while the bond market hemorrhages and real assets like silver get manipulated to maintain confidence in fiat currency. The paper silver market is a control mechanism. It's designed to suppress price discovery and prevent silver from signaling what it actually wants to signal, that the dollar is in trouble. But the physical market doesn't care about narratives. It only cares about supply and demand. And right now, supply is evaporating while demand is surging. This is the setup. The paper market can win battles, but it can't win the war. Physics beats fiction every time. So here's my question for you. Are you watching this divergence as closely as I am? Drop currency T in the comments if you're tracking the physical versus paper spread. And if you're not subscribed to this channel yet, what are you waiting for? Hit that subscribe button, turn on notifications, because this story is far from over. The next 90 days are going to separate the people who understand what's happening from the people who are just along for the ride. The data doesn't lie, the inventories don't lie, the premiums don't lie. The only thing that lies is the price on the screen, and that lie is getting harder to maintain every single day. Stay sharp. Trust the data. Don't let the paper market distract you from what's happening in the physical world. The divergence is the story. The depletion is real, and the endgame is closer than most people think. This is T for currency T out.